Hello and welcome back to the Wealth Equation Podcast. I'm your host, Maurice L. Wilson. Thank you again for joining me on Wealth Wednesday. And today is exciting because today coincides with an announcement from the Federal Reserve, otherwise known as the Fed. And what the Fed does is meet quarterly and announce if they're going to increase rates, hold rates steady, or lower rates. So what does that all mean? All of your interest rates that you pay on your loans, your mortgage, student loans, credit cards, most importantly, credit cards, car loans, pretty much any debt you have that's not locked in is determined or based somewhat on what's called the Federal Reserve rate. And so as this rate goes up, your cost of debt goes up. As it goes down, the cost of your debt goes down. And so today, the Federal Reserve met and announced that they're going to leave rates steady. And the reason being is they want to see how the tariffs that have been implemented are going to impact the economy. And for further clarification, what happens is the Fed's job is to keep inflation low and to keep unemployment, I think, at 5%. And so when we have things that impact the economic cycle, and an economic cycle is simply you're receding, a recession, you're expanding like a bull market. And so if we enter a recession, the Federal Reserve has tools to help make the recession shorter. And one of those tools is the Federal Reserve can lower rates. If we are growing too quickly, the Fed will lower rates. Now, increasing rates if we're growing too quickly, the Fed will raise rates. The reason they do that is if you have a recession, you want to make access to money really cheap so people can go in, buy stuff, and get the economy back on track. If the economy is growing too fast and we have inflation, then they raise rates to make things more expensive to kind of bring that under control. So as it stands, tariffs, which are a tax on the consumer, which may lead to people buying less goods and services, particularly less goods, may put us in a recession. So if that happens, the Fed wants enough ammunition to lower rates. Right now, they're standing pat. And I think it's a good decision because we just don't know enough. It's been a very tumultuous first quarter of the year in terms of lots of economic news, if you will, flooding the markets. And we're trying to see how this is going to shake out in the economy. So the Fed is doing the same. The Fed is saying, hey, we don't have enough information to see the impact of everything that's happened. And the Fed's not in a rush to do anything that will interrupt the cycle. So they're just going to hold back and wait. I think it's a good decision. And I think we will know more as the months go on and we move through the second quarter. So what I wanted to do today was just react to that. And I think the best way to do it is go to one of the websites I like to go to, Yahoo Finance. And so what I want to do here is just kind of go through that. I don't have my drawing tool, if you will, so follow my cursor if you can. I just want to start with the first headline here, like the Fed holds rates steady. We aren't really here to have political conversations, but let's at least talk about why they are calling for cuts. As I said in the open, they want to cut the interest rates. At least the administration wants to cut the interest rates to offset the tariffs. Tariffs are a cute word for taxes, right? There are taxes on goods from another country, right? And the taxes are paid by the consumer. So to help spur the buying that would be reduced, if I go to you and say, hey, that house you wanted to buy, or let's just say that car you wanted to buy, that movie you wanted to watch from overseas, that t-shirt you wanted to buy, it's now going to be 100% more expensive because there's 100% tax on it, right? You would buy less. So what the administration wants to do is make access to capital cheaper through lowering interest rates so that they can offset some of that reduced demand and keep us out of a recession. What the Fed wants to do is say, well, we understand that, but let's see if we're actually going to head into a recession. Now, why would they want to wait and see? Well, that's a good question. So let's look at the headlines here. And I saw something here. If you see my cursor right here, it says it's hard to see how the US avoids a recession. Um, there's so much change. I'll skip the word damage. There's so much change that has happened uh, in the first quarter and 1 month of this year that, you know, tourism's going to be down. We were looking at buying a car, and the dealership was like, look, we can only get what's in our network. We're not shipping in any more cars. They just so happened to have the car we wanted, so we bought it. But if they didn't, we would have sat on our hands, right? And waited. When people make these trade-offs because of changes to the supply chain, it has a multiplying effect. You know, you've heard of the wealth effect. What is the wealth effect? The wealth effect is when, hey, my investment portfolio is doing good. I feel good about my retirement. I feel good about my pockets. So I'm gonna go out and splurge a little bit. Well, the reverse is true. If people hear that things are not available, right? If they hear that things are gonna be more expensive, initially they'll do some hoarding for the food items and little things like that. But the big ticket items are going to push off to the side and take a wait and see approach. Well, as a business owner, the last thing you want is people pushing buying decisions off to the side because that means inventory is not moving off the shelf. If enough inventory doesn't move off the shelf, your household's doing it and my household's doing it, and then we're on the social media channels and we're hearing this and hearing that, it culminates in a contraction in the economic cycle. And so there's a lot of buzz on Wall Street and in the economist environment or circles that, yeah, we're pretty much a guarantee that we're going to hit a recession. Um, for added context, a recession is when we have two consecutive contractions in the gross domestic product, the GDP. The GDP, some people don't like it, but it's a way that we measure the output of our economy. And if that output is lower 2 quarters in a row, that's how they deem a recession. So the first quarter, we had a contraction. People didn't make a big deal about it, but it did happen. So we only have to have another quarter of contraction to have a recession. Now, recession is a big bad word. You know, what does it mean? It can mean rising unemployment. We're already seeing, you see here, Google's cut about 200 staff. That's not 2,000, but it's 200. It's chip, chip, chip. I've seen a number of layoffs at a lot of Wall Street firms. I think FedEx or UPS, they closed down or laid off a significant number of people. Big tech in general has been laying off their workers, kind of getting rid of some low performers, but it's layoffs. Factor in that the Federal Reserve laid off, I'm sorry, the federal government laid off a lot of people as well, or just flat out fired them. And you've got a lot of layoffs, right? Luckily, the job number was not too bad. So, you know, we were okay. But that jobs number factors in a lot of the change happening in the middle of the quarter, i.e., a lot of the job cuts happen around February. The quarter ends in March. So this second quarter, when we go through this quarter, we'll get the full brunt of all of these layoffs, and it could result in a higher unemployment number. So let's look at the market when we get into all this. Let's look at a chart because there are many of you out there that are investing in the stock market, somewhat reluctantly, most likely. And so this is, Yahoo Finance. They've gotten a lot better. I am not compensated by Yahoo, but Yahoo has gotten a lot better with their charts. It's not as buggy. And so I really like that. So what I want to do here is just kind of take you through, this is just basic technical analysis. There are a lot of you out there who are very into the charts and tech. I'm not trying to impress the smartest of you out there. I'm trying to just provide some general guidance here. So if it's too basic, definitely I have some people you can talk to. But for the mom and pop investor out there, let's go through it. So this is a chart of the S&P 500. If you see my cursor highlighting on the upper left, that's kind of the broadest stock market index that we follow. It's comprised of 500, actually slightly more than 500 US companies representing some of the biggest companies in the market. It's kind of what they use to benchmark performance of the market. A lot of people hear about something called the Dow Jones. That was the former granddaddy of them all, but because it's easier to relay how the market moves through the Dow Jones, you still hear a lot about it. Maurice, what do you mean relay? If I told you the market was up 24 points, it doesn't mean anything. But if I tell you the market's up 500 points, it means something. And so that's why you still hear from the Dow, but the S&P is the one people follow. So you have this chart here. It means largely nothing to anyone, right? But this is a 1 year chart. On the bottom right here, you'll see my cursor circling around the 1Y. So how do we break down this chart? So what first thing we want to do is we want to find out some type of trend line or average in the market. Think of it like your grades, right? I give you a bunch of grades. You see some letters or some numbers, depending on where your kids are in the school system. They don't mean anything. So what you do is you get a GPA, a grade point average. So what we want to do is get a grade point average for this market. So this red line, I'm just going to slide my chart to the left here. This red line is a 50-day moving average. Don't worry about the 50 part. Just know that it's a short-term average for the market. And how it literally works is it takes the last 50 days of the market's prices and just divides by 50. So 50 prices divided by 50, and you'll get this here. This coincides, we'll just go here. Right now it's coinciding with about 55.61 here on the right side. So that means that the average price over the last 50 days is 55.61. What does that mean for the market? The index, the S&P 500 in the blue here, is above that. So that means the market is above average. Don't overcomplicate it. That's simply what it means. It's above average. And what the market wants to do is stay above that average. Everything in the market is trying to go higher, right? So it's good that over the last 50 days, the market has gone over the average price. That's a good sign if you're looking to put more money in. But of course, it's not going to be that simple. So what we're going to do is add a long-term average. So this black line is the 200-day average. So over the last 200 days, the average price is 57.47. So you'll see here the blue line, which is our market, the S&P 500, is between or it's under the long-term average, but above the short-term average. So when you're under your long-term average, think of it like this. You know somebody and they usually do a thing. Oh, Susie's usually here on time. Susie usually does good work. Susie usually does fill in the blank. Okay, that's her long-term average. Now, she may have some good or bad days. Those are going to be a short-term average. But over time, let's say over a series of weeks, if they're below what they normally do, that's always bad. So right now the market is below its a long-term average. That is bad. So what does that mean? For people who are trying to see where we are in the market, yeah, we're getting better, but we're still basically bad, and so people who are wondering, hey, are we going to avoid a recession? Hey, is the market going to go back down? If you look at this, you would say, yeah, I mean, we're still, not out of the woods yet. We're not out of the woods. We're getting better, but we're not out of the woods. So if you wanted to know, Maurice, what's another sign that we are getting better, it would be this right here. So I'm going to come back over here. I'm going to draw a line right. Let me slide my chart over here. I'm going to draw a line right here. There we go. Okay. And let's make this line. Let's see if I can change the color. Give us something here. Yeah. All right. Let's make this. Let's make this. Let's see here. Okay. All right. So it's green, but it probably doesn't look green. This line right here is important. So this line is coming off of kind of the last highest point of the market in recent history. Okay. And so we need the blue line here to eclipse this line to really provide some confirmation that we are getting, substantially better in the market. That line coincides with 57.77 on the market. Is slightly above the market's long-term average. All right. And so that line can be resistance where the market hits it and goes back down, or it can eventually be support. So when the Fed comes in and holds rates steady, and it says, hey, we want to keep an eye out for a recession. When economists are thinking, hey, we still think we're going to hit a recession, those are things that you take into account. And then you come look at your chart and you say, okay, yeah, the market's been up a lot since April 4th or April 8th here. It's done a lot of work getting back, but it's still not higher than where it was in late in March. It's still not higher. It's done a lot of work, but it's still not higher. So we still may have some downward action in the market, especially after having about 9 consecutive days of growth in the market as we closed out or opened up May. So that's your market. Let me pivot back here to some headlines. Um, let's see what else is going on here. So there's an investment theme. Before all this broke out, everybody was in the AI, right? AI, and with AI, you needed semiconductors. Semiconductors are those little square chips they put in all this stuff to make these devices go. And so NVIDIA and AMD are some of the biggest providers. Well, there was some regulation around those companies and how much they could export when the last administration was in office. So there's been news that they're going to scrap that regulation. Now, the problem with all of this is you still have supply chain problems because there's also tariffs on bringing chips manufactured outside of the U.S. to be sold, and so there's some conflict there. But in looking at these headlines, you can see where NVIDIA and AMD, they're up because the administration is looking to scrap AI chip regulation. And then you've got Microsoft urging senators to hurry up regulations so that they can do more with AI to boost government access. So if you're a Microsoft investor, NVIDIA investor, AMD investor, those are potentially good signs that that AI story is still going along. NVIDIA, AMD, they're powering the AI. Microsoft through Chat GPT is organizing and using it and applying it. And so those are two parts of the AI story. So that's another thing going on in the headlines right now. Then you got Moody's right here. Moody's is a rating agency. They're warning of risks posed by retail exposure to private credit. So what that means is there's a lot of private kind of credit going on, private lending, private backing going on. And they're just saying they may have too much exposure to that. Basically, if you get all your money from one source, right, and something happens to that source of money, you could be out of business quick, right? We saw that during the Great Recession. A lot of theme parks just, their funding dried up, their credit dried up, so they couldn't even open during the Great Recession because they had all their money coming from one place. It's no different than companies that are built off one contract. If that contract goes bad, hey, you're out of business. So they're just warning on that. Things like that could portend the story of a recession. So those are some of the things we're seeing going on with the market and with the Fed headlines. Scroll down here, see if there's anything else. It's a good story here. Do mortgage rates go down in a recession? Really, this depends, right? The Fed is going to lower rates in a recession, but mortgage rates don't always immediately go down. Sometimes it takes a little bit more to get those down. So, like I said before, when I open up, everything is affected by these Federal Reserve rates. So today was a big day with them holding them steady. All right, all right. So we have to be careful about giving like general advice, right? You know, in or just specific advice, I should say, in the markets. But one thing I do want to highlight here, I'm just going to go back to my chart because that's where we live. Um, these charts, they look like squiggly lines and like nothing's happening. But I do want to point out, I'm going to simplify it a little bit. For those of you who like to run and hide, when the markets are going down, remember, markets work both ways, right? So if you see here, this is where things got absolutely the worst back on April 8th. And then we did the Fed pause, right? And then since then, I'm going to put a comparison here just to kind of show you. So since that pause, you can see here, if you follow my cursor to the far right, the market's up about 11% since then. That's just if you had your money in the general market. Now, if you leaned into some of these really bad names that got beat up, like Nvidia, I'm gonna throw Nvidia up here. You can see that Nvidia, since that pause, let's just click a 1 month here, is up about 20%, right? Let's add on, let's say Microsoft with the AI story. And again, Microsoft on the far right here is up 24%. I'm sorry, 20%, and then Nvidia is up 24. And let's add something. What else is beat up pretty bad? Tesla. And I know Tesla is a firebrand here, about 15%. So when news gets really bad, you do want to do something that Warren Buffett talks about, which is you want to be greedy when others are fearful, right? And so, speaking of that, how do you know when people are fearful in the markets? This is one of my tried and true charts. It's the fear greed index. So, this index, every day you can come here and they're going to update it. They updated it at 7:59 right here. Right now, because we've had such a big run up, those charts I showed you earlier, we're inching back to that greed setup where, okay, typically when people get all in and everybody gets greedy, the market tends to go down. So we were here very fearful, extreme fear on April 8th. And in less than a month, it'll be May 8th tomorrow, we've gone all the way back up to greed. Now, typically, we don't stay too far above this 50, this midpoint, this neutral zone. So if you go back and look here, this is around the election. We have the election, we shoot up. Actually, this is before the election. The election's right here. So we shoot up going into the election, and then we come back down. So we get around the 75 mark here, the greed mark, and then we come back down, reset, and kind of go sideways. So here, back in August of 04, I think we had a scare. I forget exactly what it was, but extreme fear, get back to neutral, and then kind of sideways. So just be mindful. We've had a big run up in the markets. We had basically a relief rally where the jobs number was good, tech earnings were good, and so the fear has come out of the market. And now we're back over into the greed side. Doesn't mean we're going to go down tomorrow, but just be aware that, okay, the sentiment is that, hey, we're done with all of the tariff stuff. We're going to work it out. There's all these talks going on. Well, now people are starting to get greedy. And so just be mindful that when we're in this greed and extreme greed territory, markets may do a reversal. So that's not to be scared. That's just to know that you may get some better prices if you miss the run up coming off of April 8th. And that's the beautiful thing about the market. Everybody knows about an area of their city or a place they've lived where real estate that was, got to add here, real estate that was depressed for a very long time suddenly gets gentrified and it's worth millions and everybody wishes they would have gotten in. The market does that all the time. The market gives you the opportunity to, you miss a rally, you miss a buying opportunity. The market will give you opportunities to get back in a pretty frequent manner. I'm going to pull up a chart here and just kind of show what I'm talking about. Let's get rid of some of our friends here. Get rid of that, that. And then we'll just hide you. So I'm gonna hit a 1 year on this, and this kind of let's see here, and let's get rid of my chart here. See if I can delete. There we go. All right, and hide. So let's go back to 2022. Well, let's do 2020 with the pandemic. So this big drop right here, this is going into the pandemic, and then we fall all the way down here, right? That was a great buying opportunity because when you zoom out and use the pandemic on the far left, you can see from the bottom in about March of 2020 all the way through just 2021, you almost had 100% gain, right? So let's say you missed that, right? And it was like, wow, I blew it, right? Well, don't fear because in 2022, the market fell. You see here, it started falling on January, the upper left. It fell all the way through October. And if you look on the far right, it fell 25%. That was another buying opportunity. When you come off that, again, you get about a 40, zoom this out a little bit more. Yeah, right before we have all of the stuff we've had recently, you get a nice, I'm trying to get my chart working here, excuse me. Let's just say through here, you get about a 40%, actually more than that, about a 60% gain buying at that 2022 low. And that's just the overall market. When you look at just stocks in general, so people always say, I wish I would have bought NVIDIA, at a certain price point. Well, in 2022, again, this is our kind of October bottom in 2022. If you look at that far right, NVIDIA coming off that 2022 market, just 20% decline. Before we get into 2025, NVIDIA goes up 1,000%. So what does that mean? For every 1,000 you put in, it went up 10x. So 10 times 1,000 is 10,000. You put 100,000 in, it's a million, right? So now people say, I missed that, right? Well, let's look at NVIDIA over the last year, okay? What you'll see here is that blue line, NVIDIA went down about 30%. It's another buying opportunity, potentially, right? They're not the only ones, though. If I come here and let's add, who else got hit? Let's go with Microsoft. And let's just do a year to date. Let's come out. Go. Probably not coming through on the chart very well, so I might want to pull that one off. Let's go with Apple. There we go. Okay. So Apple right here is down, this green line, 24% through April. That's a really good buying opportunity. And since then, it's really rallied up, right? So the thing is, when these stocks take off and get away from you, keep an eye on them, right? This is where charting comes in. I typically like 3 different price points for buying a stock. I've gone over that in prior podcasts. So if you check out my page, the Wealth Equation Podcast on YouTube, or listen to me on Podbean, we have previous episodes where we talk about different buying points. So I am going to roll back to the headlines and just start to close us out. What's the takeaway, right? Okay, the Federal Reserve has held rates steady. Okay. And so that means that they aren't going to raise them, they aren't going to lower them. They don't want to make any decisions until they have more information. Now, I think if they could come out and just say, hey, this is what we think. The Fed thinks we're going to have a recession. And what they want to do is they want to lower rates to stimulate the economy when that recession shows up. That's what they really think, right? If they thought we were expanding, if they thought everything was good, they'd make a different decision. They're looking at all the damage that's happened. And they're saying, hey, if you can fix it, good, we can do something. But we're thinking you can't fix it. And so we're holding our tools until we have to actually pull them out. Economists agree with that position. Economists are largely saying, hey, there's almost no way we can avoid a recession just given what's happened. There are people out there who have jokes about economists predicting recessions, and they've been trying to predict one for a while now. But this time they really have something. I mean, the supply chain has been disrupted um, a lot, right? You had one story where Apple was airlifting phones into the country to get around tariffs, right? When you got Apple airlifting phones versus doing them the normal way, your supply chain is pretty messed up. So at some point, that has to have an impact on the consumer. I've already told you about when we went to buy a car and we couldn't necessarily get the car we may have wanted off the lot. Luckily, it was on the lot, but if they had to order it, they wouldn't have been able to get it. Well, somebody, drew the short straw in that situation and they weren't able to get the car that they wanted, right? So those are going to have impacts on our gross domestic product, which is how we measure recessions. Recessions are measured by how by the gross domestic product contracting 2 consecutive quarters. It contracted in the first quarter, so we're up for the second quarter. If it contracts again, we'll have an official recession. So there's a lot leaning in that recession camp, and we'll see. I mean, this quarter started in April. We're into the middle of the quarter in May. You got tourism season coming up. A lot of people are not traveling due to a lot of different reasons. So we've got a lot to digest to see if we can make it out of this quarter without a recession. What does that mean for you as an investor? Hey, you may get some more buying opportunities. One thing I should note is that markets do bottom before recessions end. So, and you don't know you're in a recession until after it's happened, right? So you could argue that where we were in April was the bottom of the stock market, and we just got to work our way through. Time will tell. But for investors, keep your eyes peeled for some unique buying opportunities in your favorite stocks. A lot of the tech stocks that we know and love, the Magnificent Seven as they're called, are still lower than where they were in late 2024. So something to consider. But also look at things that may be what we call tariff proof, things that are made in the US. They're going to be boring, but boring may be the way that we go in this new economy where we're onshoring a lot of production and maybe getting away from tech stocks purely as the main investment. So that's all I have for tonight. I do thank you for joining me today on the Wealth Equation. We are looking to add another segment to the podcast on Sundays. You don't know this, but I was trying to do it this Sunday and things fell through. But we're looking to add strategic Sundays to our podcast where we sit down and talk about the week that's coming up and some moves you may want to make or consider before the week gets going. Trying to give you something right before the start of the week, something in the middle of the week, and then leave you alone on Friday and Saturday. So keep an eye out for that. YouTube, you can find us on YouTube at the Wealth Equation Podcast. You can find us at wilsonwealth.com. And of course, on Instagram at Wilson Wealth. And you can also find us on Facebook at Wilson Wealth. My name is Maurice Wilson. It has been a pleasure talking to you this evening. Have a great week.